Margaret is 71 years old. She has been a customer at the same bank branch in suburban Columbus, Ohio for 26 years. Not because it is the most convenient location in the city, because she knows the branch manager by name and because she has never had a problem in more than 2 decades of banking there. She walked in on a Tuesday morning in March 2026 to withdraw $12,000 in cash. She needed the money to pay a contractor who had been hired to repair her roof after the February ice storm caused significant structural damage. The contractor accepts cash only. Margaret had the money in her account. She earned it over a career as a high school science teacher. She deposited it at the same branch over decades. She had every legal right to every dollar of it. The teller looked at the withdrawal request and asked why Margaret needed $12,000 in cash. Margaret explained, roof repair, ice storm damage, contractor needed cash. The teller said the transaction had been flagged by the system. A supervisor was called. Margaret was asked additional questions about the contractor, about how she found him, about whether someone had encouraged her to make this withdrawal, about whether she felt any pressure to take the money out. Margaret was then told the transaction was being placed on hold up to 15 business days, while the bank investigated whether she was being financially exploited. 15 business days is 3 full calendar weeks. Margaret could not access $12,000 of her own money at a bank she had trusted for 26 years for 3 weeks, while her roof sat unrepaired, while the contractor waited, while the February ice damage worsened with every passing week, because an algorithm saw a 71-year-old woman withdrawing an amount larger than her typical transaction pattern and flagged it as potentially suspicious. The bank was not malfunctioning. The bank was exercising legal authority that a federal regulation specifically grants to every financial institution in America that handles investment and retirement accounts. Authority that has grown significantly more aggressive in 2026. An authority that most seniors with bank accounts have never heard of and are completely unprepared to navigate when it activates without warning. Welcome to the Digital Defender. There are 4 banking rules operating in 2026 that give your bank the legal authority to block your access to your own cash without your permission, without advance warning, and in some cases, without any obligation to explain why in real time. Each rule has a specific trigger. Each rule has a specific defense. And not knowing any of them before they activate is the difference between accessing your money when you need it and standing at a teller window being told no while your roof leaks. Smash the like button right now, because every tap pushes this into the feed of one more senior who keeps money in accounts they have used for decades and has no idea 4 rules exist that can legally block that money without a single phone call of warning. Hit it now. Subscribe and flip the notification bell to all. Pass this video to anyone you know over 60 who uses cash regularly. That is the single most important thing you can do after watching it. This is not legal advice. This is the masterclass on 4 banking rules that are actively affecting seniors in 2026, and that most people discover only after the rule has already activated against their account. Rule 1. FINRA Rule 2165. If you are 65 years old or older and you hold a brokerage account, a retirement account, an IRA, or any investment account, this rule applies to you specifically by name. It was written for your age group by name. FINRA Rule 2165 is titled Financial Exploitation of Specified Adults. A specified adult under this rule is a natural person aged 65 or older, or any adult the firm reasonably believes has a mental or physical impairment, makes them unable to protect their own financial interests. The rule grants every FINRA-registered financial institution a legal safe harbor to place a temporary hold on any disbursement of funds or securities from a specified adult's account when the firm reasonably believes that financial exploitation of that adult is occurring, has been attempted, or will be attempted. The standard is reasonable belief, not proof, not evidence, reasonable belief. The difference between those 2 standards is the difference between your bank needing to demonstrate actual evidence of exploitation before blocking your withdrawal and your bank needing only to have a plausible basis for suspecting it. An unusual withdrawal amount, a transaction to a new recipient, a pattern that deviates from your account history, a teller who interprets your body language as nervous or pressured, because tellers in 2026 are specifically trained to flag anxious or hurried behavior as a potential exploitation signal. Any of these can generate a reasonable belief without a single piece of actual evidence that anything is wrong. The initial hold under FINRA Rule 2165 lasts up to 15 business days from the date the hold is placed. If the member firm reports the suspected exploitation to a state regulator or agency of competent jurisdiction, the hold can be extended. The current maximum total hold period under the rule is 55 business days when all extensions are exercised. In January 2026, FINRA issued Regulatory Notice 2602 proposing to increase the maximum hold period from 55 business days to 145 business days, 3 calendar months, with 3 additional 30-day extensions available if the investigation remains unresolved. FINRA accepted public comment on this proposal through March 2026. If the proposal is adopted, a single flag transaction on your retirement account could legally block your access to those funds for nearly 7 calendar months. The financial exploitation problem FINRA is responding to is real. Americans 60 and older lost $4.80 billion to financial scams, according to FBI data. The rule was designed to protect seniors. The rule works as intended when it catches a genuine exploitation attempt. It creates a serious problem when it catches a legitimate transaction and a 71-year-old woman trying to fix her roof becomes collateral damage in a well-intentioned system. The defense is specific and takes 5 minutes. Before any large or unusual transaction, call your financial institution and tell them it is coming. 1 sentence. I am planning to withdraw $12,000 next Tuesday to pay a contractor for a home repair. That phone call creates a documented record in your account file that the transaction is expected intentional and planned. The institution notes it. The algorithm has context it would not otherwise have. The likelihood of a hold drops dramatically. Additionally, set up a trusted contact on every account you hold. Under FINRA Rule 4,512, member firms are required to make reasonable efforts to obtain a trusted contact person for customer accounts. The trusted contact is a family member or trusted friend the institution can call to quickly verify your safety and confirm a transaction is voluntary. The trusted contact has zero access to your money. They cannot view balances, make transactions, or give any instructions about your account. They are purely a verification contact. One of the primary reasons holds get extended past the initial 15 business days is that the institution cannot reach anyone to verify the account holder's safety in time. The trusted contact solves that problem before it becomes one. Rule 2. Structuring. This is the rule that catches seniors by complete surprise because it makes a federal crime out of an entirely innocent and logical behavior. And because the federal government can seize your money under this rule without ever charging you with a crime. Under the Bank Secrecy Act, at 31 U.S.C. 5313, financial institutions are required to file a currency transaction report with the federal government for any cash transaction of $10,000 or more in a single day. This includes deposits and withdrawals. The report goes to the Financial Crimes Enforcement Network. Most people have a vague awareness that large cash transactions get reported. What most people do not know is what federal law says about transactions that appear designed to stay under that threshold. At 31 U.S.C. 5324, the Bank Secrecy Act makes it a federal crime to structure or assist in structuring any cash transaction for the purpose of evading the $10,000 reporting requirement. Breaking a large cash amount into smaller transactions, specifically to stay under $10,000 is called structuring, and it is a federal crime regardless of whether the underlying money is completely legitimate. The criminal penalty under 31 U.S.C. 5322 is up to $250,000 in fines and up to 5 years in federal prison. But the criminal penalty is not the most dangerous part of this rule for seniors. The most dangerous part is civil asset forfeiture. Under 31 U.S.C. 5317, any property involved in a structuring violation can be seized and forfeited to the United States through a civil proceeding. The government does not need to charge you criminally to seize your money under civil forfeiture. They need only demonstrate probable cause that the funds are connected to a structuring violation. Your money is gone. The burden then falls on you to prove your money was not involved in structuring to get it back. Carol Hinders owned a small restaurant in Iowa called Miss Lady's Mexican Food. She ran it for 38 years. Cash-only business. She deposited her legitimate cash income the same way she always had. In 2013, the IRS seized $33,000 from her account. She had never been charged with the crime. She had never done anything illegal. She simply had a pattern of cash deposits that the algorithm flagged as potential structuring. She spent over a year fighting to recover her own money. Lyndon McClellan ran a convenience store in North Carolina. In 2014, the IRS seized $107,000 from his business account. His business was completely legitimate. His money was completely legal. His deposit patterns triggered the structuring algorithm, and the government took everything. The Treasury Inspector General for Tax Administration conducted an audit of IRS structuring seizures and found that the IRS largely pursued cases involving legal source funds from business accounts and primarily relied on the pattern of banking transactions to establish the violation. Most structuring seizures were made against people whose money was completely legitimate. The rule was built to catch criminal enterprises. It has been systematically applied to people who had no criminal intent and simply had a banking pattern that looked like evasion to an algorithm. The defense is as simple as the rule is aggressive. If you need to make a large cash transaction, make it as a single full transaction. Yes, the bank will file a currency transaction report with the government. That report is completely routine. Banks file millions of CTRs every year. Having a CTR filed in your account does not trigger an investigation automatically. It does not mean you are under scrutiny. It means the bank followed the law. What triggers an investigation is the pattern of transactions that appear designed to stay under the threshold. A single $12,000 withdrawal generates one routine government report. 12 separate $999 withdrawals over the same period generates a structuring flag that can lead to a federal investigation and civil forfeiture of every dollar in the account. Make the full transaction. Let the report be filed. The report is harmless. The pattern is not. Send this video to one person right now before you continue watching. Person you know who handles cash regularly. A neighbor, a sibling, a friend who mentioned their contractor only takes cash. Not after you finish watching. Right now. Because the structuring rule has no intent requirement. The algorithm does not care why you made multiple transactions under $10,000. It cares that the pattern exists. And by the time someone explains the rule to most people, the pattern has already been flagged. Rule 3. The Cash-Light Branch. In 2026, most major banks have been converting physical branch locations to formats they call advisory centers. These locations frequently operate with no traditional teller line and limited cash inventory on hand. Large cash withdrawals at these locations are not available on a walk-in basis. If you need more than a few $1,000s in cash, you may be told to schedule an appointment several business days in advance or to accept a cashier's check instead. In early 2026, standard ATM daily withdrawal limits sit between $300 and $1,000 at most institutions, with premium accounts accessing up to $3,000. The branch itself offers higher access than the ATM, but that access now increasingly requires advance notice, especially for amounts above $5,000. The 2026 landscape has also tightened internal scrutiny thresholds below the federal $10,000 CTR level. Under updated anti-money laundering guidelines, many institutions are now applying enhanced scrutiny to cash withdrawals between $3,000 and $10,000. A teller may be required to call a manager and ask about the purpose of the funds for a withdrawal of $4,000. If the explanation is vague, the teller may limit the withdrawal or decline it entirely to avoid the institution's liability for facilitating a potential scam. Additionally, starting in 2026, new reporting requirements ask banks to provide more detailed reporting on cash transactions between $1,000 and $10,000 to regulators. The surveillance infrastructure below the $10,000 federal threshold has expanded significantly this year. The defense is two steps. First, call your branch this week and ask specifically what their cash policy is for withdrawals above $3,000. Ask whether advance notice is required. Ask how many business days of notice they need for a withdrawal of $5,000 or more. Know the answer before you need cash urgently, rather than discovering the appointment requirement at the window when the contractor is waiting at your door. Second, establish an account at a second institution as a financial backup. A credit union or a community bank that has not converted to the advisory center model maintains traditional teller service and cash availability. Maintaining a modest balance at a second institution that you can access when your primary bank has converted to appointment-only formats is not excessive caution. In 2026, it is basic financial planning for anyone who uses cash for larger transactions. Rule 4, the dormant account. If you have a savings account, an emergency fund, or any account you keep as a reserve and rarely touch the bank's automated system, may already be classifying it as dormant. And the legal process that activates when that classification is confirmed moves faster and with less warning than most people expect. Under the unclaimed property laws of every state plus the District of Columbia, a bank account is considered abandoned or unclaimed when there is no customer-initiated activity for a period of 3 to 5 years depending on the state. When an account reaches the dormancy threshold, the bank is required to transfer the funds to the state treasurer through a process called escapement. The state takes custody of the funds as unclaimed property. The account at the bank is closed. The critical detail that catches seniors by surprise is the definition of activity. Most people assume that an account with automatic interest being deposited or automatic dividend payments being credited is clearly active. The account is receiving money. The bank knows the account exists. How can it be dormant? The escapement process does not count automatic transactions as customer-initiated activity. Interest being posted to your account by the bank is the bank's transaction, not yours. A dividend being credited to your brokerage account by the investment fund is the fund's transaction, not yours. Only a transaction you initiate yourself, a deposit, a withdrawal, a transfer, a login to check the balance in some institutions, resets the dormancy clock. An account that receives automatic interest every month for 3 years with no owner-initiated transaction is still a dormant account under most state laws. There are currently an estimated $58 billion in unclaimed funds held by state unclaimed property programs across America. That number represents money that belongs to living people who simply do not know their account was transferred or who cannot navigate the claims process to recover it. Every state has a claims process through unclaimed.org. The process works, but it requires paperwork, identity verification, and documentation, and it takes time. It is not fast when you discover the transfer at a moment when you need the money immediately. The defense is the simplest of the 4 rules and requires exactly 1 action per year per account. Log into each account you hold and make at least 1 manual transaction, a small transfer in, a small transfer out. A manual balance check that registers as an owner-initiated contact with the account in the bank system. 1 transaction, once a year, per account. That single action resets the dormancy clock entirely and keeps every account you hold active in the bank system, regardless of whether you need to touch the funds. Set a calendar reminder right now for January 15th of every year, labeled Bank Account Dormancy Check. On that date, log into every account you hold and make 1 transaction in each one, including savings accounts you keep for emergencies, including certificates of deposit accounts, including any investment account you contribute to annually but do not trade actively. 1 reminder: 0 risk of losing access to accounts you have held for years. Here is what connects all 4 rules. FINRA Rule 2165 gives your financial institution the legal authority to freeze your retirement and investment account transactions for up to 55 business days, based on a reasonable belief of exploitation with no proof required. A 2026 FINRA proposal could extend that freeze to 145 business days. The defense is advance notice of unusual transactions and a trusted contact on the account. Structuring under 31 U.S.C. 5324 makes it a federal crime to break large cash transactions into smaller amounts to avoid the $10,000 currency transaction report requirement even when the money is completely legitimate. Civil forfeiture allows the government to seize your money without criminal charges and places the burden on you to prove you should get it back. The defense is making full transactions and letting the CTR be filed. Banks in 2026 are converting branches to advisory centers with limited cash inventory and appointment requirements for large withdrawals while tightening internal scrutiny below the federal $10,000 threshold. The defense is knowing your branch's cash policy before you need cash urgently and maintaining a backup banking relationship. Dormant account laws in all 50 states transfer inactive accounts to the state treasurer as unclaimed property when no owner-initiated activity occurs for 3 to 5 years. Automatic interest does not count. The defense is 1 manual transaction per account per year, resetting the dormancy clock. 4 rules, 4 specific triggers, 4 defenses that take minutes to implement. The difference between being blocked from your own money on a Tuesday morning at a branch you have used for 26 years and accessing exactly what you need when you need it. Before you leave, do 3 things. Pass this video to anyone you know over 60 who uses cash regularly or who has accounts they do not touch often, right now, not after you finish watching. The structuring rule alone has ended people's access to their own legitimate savings, and the people it catches hardest are the ones who never knew the rule existed. Subscribe to this channel and flip the notification bell to all. Banking rules affecting seniors are changing faster in 2026 than at any point in the past decade. New proposals, new internal thresholds, new surveillance requirements below the federal reporting level. Every week, this archive covers the rules your bank is not explaining and the defenses that protect your access to your own money. You want to be inside it. Drop a comment below right now. Tell me your state. Tell me whether you have ever been asked by a teller why you needed a large cash withdrawal. Tell me whether you knew any of these 4 rules existed before you watched this video. I read every comment. Your experience tells me which of these 4 rules is activating most aggressively against seniors in your area right now. I will see you in the next investigation. Stay sharp, stay protected, and do not let any bank tell you no to money that is legally and completely yours.